If you pull up the historical chart for StoneCo, ticker symbol STNE, you see this classic arc, right? Like the arc of a Silicon Valley style darling.
Oh, absolutely. The classic tech disruptor story.
Yeah. A company that pitched itself to you and me and the whole market as this nimble, asset-light, tech-first digital payments giant.
Right, aiming to completely democratize payments in Brazil.
Exactly. And, dismantle the legacy banking oligopoly while they were at it. But, and this is why we're doing this deep dive today, reading through the raw transcript of their Q1 2026 earnings call, and especially the subsequent analyst Q&A. I mean, I didn't see a tech company.
No, not at all.
The conversation wasn't dominated by software innovation or like frictionless user experiences.
Right.
Instead, management spent the hour agonizing over non-performing loans, duration mismatches, shifting benchmark interest rates, and the cost of wholesale funding.
Yeah, it sounded exactly like the quarterly check-in of a heavily regulated 100-year-old commercial bank, honestly.
It really did. It is this profound identity crisis playing out in real time on the public markets.
It is. And for anyone holding this stock, or, looking at it as a potential value play right now, recognizing that shift is the entire ballgame.
For sure.
You are no longer analyzing a high-growth payments processor. You're analyzing a financial institution that is actively trying to rebuild its balance sheet.
Right, while navigating one of the most volatile macroeconomic environments in Latin America.
Exactly. And the top-line numbers, they present one reality, but the underlying mechanics of how they're generating revenue right now, it reveals a totally different, highly defensive posture.
And that defensive posture is exactly what we need to decode today. We're looking squarely at the Q1 2026 results.
Yep.
The goal here isn't just to recite the earnings release. I mean, Wall Street algorithms do that in milliseconds.
Right, you don't need us for that.
Exactly. The objective for this deep dive is to dig into the actual operational data, translate the dense banking jargon they're throwing around, and figure out if this massive transition is actually going to reward retail investors like you.
Let's get into it.
So let's start where the market usually starts, with the headline numbers.
The top and bottom lines.
Right. And immediately we run into this mathematical disconnect. So total revenue and income came in at 3.6 billion Brazilian reais.
Which is, what, a very modest 6% year-over-year growth?
Yeah, exactly, 6%. And then adjusted net income was 549 million reais, up just 3%.
So we have single-digit top-line growth and even slower net profit growth.
Right, which clearly points to margin compression.
Absolutely.
Yeah, and this is the wild part. They reported an adjusted basic earnings per share of 2.19 reais. That is a 15% jump.
Right.
Okay, let's unpack this. How does net income only grow 3%, but earnings per share jumps to 15%? The math feels disconnected. I mean, I know how share repurchases work, but using buybacks to turn 3% actual growth into a 15% EPS headline, it feels like aggressive financial engineering to mask a sputtering core engine.
Yeah, I mean, it's the quintessential late-stage corporate maneuver.
Right.
When organic growth slows to single digits, you manufacture per-share growth by shrinking the equity base.
Shrinking the pie so the remaining slices look bigger.
Exactly. And the sheer scale of what StoneCo is doing here deserves serious attention because it dictates the short-term trading dynamics of the stock.
How so?
Well, they distributed 3.6 billion Rios to shareholders year to date. That translates to an astronomical 27% capital distribution yield.
Oh, wow. 27%.
Yeah. But we have to isolate the noise there. A massive chunk of that was the extraordinary dividend paid out on May 4th from the Lynx software divestiture.
Right, the Lynx sale, which in itself is a massive strategic retreat for them.
Oh, totally.
I mean, they bought Lynx years ago to be this ultimate software moat. The whole idea was to embed their payment processing directly into the enterprise resource planning software of Brazilian merchants.
Yep, the all-in-one ecosystem dream.
Exactly. So selling it off, taking the cash, and just handing it back to shareholders as a special dividend rather than reinvesting it, I mean, that's management waving a white flag on that specific growth vector, isn't it?
Precisely. It is a full capitulation on the software-first thesis. They're admitting that the synergy never materialized the way they modeled it.
Right.
And rather than burning more capital trying to force it to work, they just liquidated the asset.
Makes sense.
But beyond that one-time Lynx dividend, you have the ongoing structural buyback program.
Right. The CFO, Diego Salgado, talked about this.
Yeah, Diego detailed that they executed $0.6 billion raise in ordinary share repurchases just in the quarter. And they still have authorization for another $1.4 billion to deploy through the rest of 2026.
So for a retail investor, this introduces a fascinating dynamic.
Right, it really does.
On one hand, the adjusted gross profit margin contracted nearly 300 basis points. It fell from 44.4% in Q1 of 2025 down to 41.6% this quarter.
Which is a huge drop.
Yeah. The actual underlying business is clearly becoming less profitable. But on the other hand, you have a corporate treasury department acting as this apex buyer in the open market with a mandate to spend $1.4 billion raised.
Exactly.
That creates a massive artificial price floor. Every time the stock takes a hit on, say, bad macro news out of Brazil, StoneCo's treasury is right there soaking up the liquidity.
Right. It completely alters the risk-reward profile of holding the equity.
How do you mean?
Well, management is signaling that despite the operational headwinds, they believe the intrinsic value of the remaining enterprise is significantly higher than the current market capitalization.
Okay, that makes sense.
But you bring up the critical point, the gross profit margin contraction. A 300 basis point drop is severe.
Yeah, you can't just ignore that.
Exactly. The buybacks might support the stock price today, but they do not fix the operational decay that's causing that margin squeeze. Okay, to understand the margin collapse, we really have to look at the friction between their two core business segments.
Payments and credit.
Exactly. You have a legacy payments processing business that is stalling out, and a newer credit business that effectively blew up in their faces this quarter.
Let's pull the thread on the payments business first, because, this is the foundational bedrock of StoneCo.
Yep.
The metric everyone watches here is total payment volume, or TPV. For Q1, TPV was 137 billion race. That represents just 3% growth year over year.
Which is practically flat.
Right. For a company that routinely posted 30, 40, 50% volume growth just a few years ago, 3% is stagnation.
Absolutely.
Management pointed out that PIX QR code volumes are vastly outperforming traditional card swipes.
Which makes total sense given the ubiquity of Brazil's central bank instant payment system.
Yeah, PIX is everywhere. But PIX is notoriously difficult for merchant acquirers to monetize at the same rate as a traditional credit card transaction, right?
Right. PIX fundamentally commoditized the payment rail.
Okay, explain that for a second.
Sure. When a transaction moves instantly from the consumer's bank directly to the merchant's bank, the intermediary, like the point of sale provider, StoneCo, they lose their leverage to charge premium processing fees.
Ah, I see. Because there's no credit risk or settlement delay.
Exactly. And StoneCo knows this. That is exactly why they spent all of 2025 trying to aggressively pivot their merchant base from being simple payment processing clients into full suite financial clients.
Right, the bundled services.
Yes. They recognized the physical terminal itself was becoming a low margin commodity, so they tried to bundle it with instant settlement features, credit lines, and digital banking tools just to preserve their take rate.
And based on the CEO's commentary, that bundling strategy was an unmitigated disaster for customer retention.
It really was.
Matthias Scherer spent a significant portion of the call addressing what they termed the churn issue.
Yeah, churn was a big theme.
He made a distinct point that legacy clients, the ones who have just been using the basic payment terminals for years, they're exhibiting normal historical retention rates.
Right, they're sticking around.
But the cohorts of clients they onboarded in 2025, the ones subjected to these new comprehensive financial bundles, they are abandoning the platform at an alarming rate.
The irony here is so thick. In their attempt to create a sticky, all-in-one financial ecosystem, they introduced so much complexity into their pricing architecture that they basically alienated their core demographic.
The micro merchants.
Exactly. We're talking about micro, small, and medium business owners. A bakery owner in São Paulo doesn't have the time or the financial model and background to decipher a multi-tiered SaaS pricing contract.
Right, where the transaction fee fluctuates based on their checking account balance or their utilization of a working capital loan.
Exactly. When pricing becomes opaque, the merchant assumes they are being exploited, and the barrier to switching payment providers in Brazil is lower than it has ever been.
It sounds like they tried to sell their merchants the equivalent of a bloated cable TV package.
Just a great analogy.
Like forcing you to buy 400 channels of content you don't want just so you can get the one live sports channel you actually need.
Yep.
At a certain point, the pricing friction just annoyed people into leaving. The customer just cuts the cord.
They do. And Matthias explicitly stated their response to this is a full review and simplification of the bundles. He noted that the objective now is profitable TPV growth, not volume at all costs.
Profitable TPV growth. That feels like a huge pivot.
It's an incredibly sobering pivot. Profitable growth is just Wall Street code for accepting market share losses in exchange for stabilizing unit economics. They're actively stepping away from the hypergrowth treadmill. They're patching the leaky bucket, simplifying the pricing, and accepting that 3% TPV growth might be the new normal while they cauterize the churn.
It's a necessary defensive move, sure, but it completely removes the high-octane growth narrative from the payments division.
Which forces the market to look to the other side of the house for growth, the credit division.
And the data here is a total roller coaster.
Oh, it's wild.
Look at the raw growth metrics. The credit portfolio expanded to 3.2 billion raise, which is a massive 14% sequential jump just from Q4 of 2025.
A huge jump.
Yeah. And credit revenues surged 25% sequentially to 297 million raise. The portfolio yield, like the interest rate they are successfully charging merchants, climbed to 3.3% per month.
Right.
I mean, if you stop reading the transcript right there, it looks like a wildly successful, highly lucrative lending operation.
But you can't stop reading there because the cost of generating that revenue was absolutely catastrophic.
Right.
This brings us to the most vital and frankly the most alarming segment of the earnings call. We have to talk about the deterioration of the asset quality.
Let's do it.
The cost of risk hit 21.9%. Non-performing loans, specifically the NPLs over 90 days delinquent, reached 7%.
Okay, let's translate that for the retail investor modeling this out. A 7% 90-day NPL ratio in a commercial loan portfolio. That is a flashing red siren, right?
Oh, absolutely.
It means that out of every 100 RIAs they have deployed into the market, 7 RIAs are sitting with merchants who haven't made a single payment in over a quarter.
Yep, they're ghosts.
And a 21.9% cost of risk. What does that actually mean in plain English?
It essentially means that nearly a quarter of the portfolio's principal value is being mathematically eaten by expected losses on an annualized basis.
Wow, a quarter of it.
Yeah, so the yields might be high, but the defaults are destroying the economics of the entire business line.
And that destruction hits the income statement immediately through provisioning, right?
Yes, exactly.
Diego Salgado noted they had to provision 165% for credit losses in the first quarter, leaving them with a coverage ratio of 229%.
Right.
We need to unpack the mechanics of this because this is the exact reason the gross profit margin collapsed. Break down provisioning for us.
Sure. Provisioning is an accounting requirement where a lender must recognize the expected future loss of a bad loan against today's current earnings.
Okay.
So when management says they provisioned 165%, they mean that for every dollar of bad debt that actually materialized in the quarter, they were forced to take $1.65 of actual revenue from the performing parts of the business, pull it out of their profit calculation, and lock it away in a reserve account on the balance sheet.
So the payments business grinds out its 3% growth. The performing loans generate their 3.3% monthly yield, but a massive chunk of that actual cash flow is just diverted into this quarantine bucket to cover the explosion in defaults.
You nailed it. And a 229% coverage ratio means they have deeply over-reserved against the current non-performing loans.
Which is conservative, I guess.
It is conservative, and it's generally applauded by regulators, but it severely suppresses the current quarter's earnings power.
Right. It kills the profit.
Exactly. But the vital question, and the one analysts really hammered them on during the call, is how a supposedly tech-forward company allowed its credit portfolio to degrade so rapidly in the first place.
This is where the narrative of StoneCo as an elite technology company takes a huge hit.
A massive hit.
Their entire value proposition for getting into the lending business was that their proprietary data seeing every single transaction flowing through a merchant's payment terminal would allow their automated machine learning algorithms to underwrite risk far better than a traditional bank.
That was the pitch.
Right. The algorithm is supposed to see a drop in a merchant's daily sales and automatically restrict credit lines before the merchant defaults.
But the CEO flat out admitted that starting late last year, their automated models, in his words, lost efficiency and began to underperform.
Lost efficiency. That's a gentle way of saying the models failed.
Yeah, completely failed.
Yeah.
The cohorts of loans they originated in late 2025 and early 2026 defaulted at rates completely outside their modeled expectations.
Wow.
And when pushed by analysts like Caio de Prado from UBS and Antonio Rouge from Bank of America on why the algorithms failed, management leaned heavily into blaming the macro environment.
Right, I noticed that.
Yeah.
Diego cited the overall banking industry trend in Brazil, pressure on general consumption, and just a deteriorating macro setup.
Which is an incredibly weak defense.
Right, because aren't they basically blaming the economy for bad algorithm engineering?
Exactly. Blaming the macro environment for bad underwriting implies a fundamental misunderstanding of what an underwriting model is actually supposed to do.
Right.
The entire purpose of a dynamic credit algorithm is to adjust for macroeconomic shifts.
Yeah, it should see it coming.
If inflation spikes in Brazil and consumer discretionary spending drops, the data flowing through the payment terminals should immediately reflect that stress. The model should tighten the spigot.
It should cut off the credit.
Yes. What management is quietly admitting here is that their machine learning models were likely overfitted to a benign economic environment. When the macro conditions actually shifted, the algorithms failed to recognize the localized stress on micro merchants and just kept extending credit into a degrading reality.
And Diego referred to the resulting fallout as a learning process.
Oof.
I mean, as an investor, you never want to hear the CFO of a multi-billion-dollar financial institution describe their core underwriting operation as a learning process.
Definitely not.
Especially when they're learning with $3.2 billion raise of shareholder capital. It suggests they were essentially beta testing credit policies in a live, hostile macro environment.
To their credit, though, they didn't just passively watch the portfolio burn. They initiated a massive overhaul.
Okay, what did they do?
First, they dramatically increased the interest rates they charge to compensate for the higher expected losses, which is why you saw the portfolio yield tick up.
Right. If defaults are structurally higher, the performing merchants have to subsidize the losses through higher borrowing costs.
Exactly. Second, they took the old algorithms offline, rebuilt the models with tighter parameters, and pushed the new underwriting software into production in March.
And they offered early data on that March cohort, specifically tracking first payment defaults, which is the industry benchmark for toxicity, right?
Yeah, the canary in the coal mine.
If a borrower misses the very first payment on a new loan, it is usually indicative of outright fraud or a merchant in terminal distress.
Right.
Management claimed the first payment defaults for the March cohort showed a clear improvement compared to January and February, returning to historical baseline levels.
That is a necessary data point, but it's not a sufficient one.
Why not?
Because a loan takes several quarters to truly season.
Yeah.
Just because a merchant makes the first payment doesn't mean the algorithm correctly priced the risk of them making the 12th payment in a high inflation environment.
Fair point.
But the third pillar of their response is the most structurally consequential one.
The pivot to secured lending.
Yes. They are actively pivoting the entire lending strategy away from purely unsecured credit and migrating toward secured lending backed by the BNDES, the Brazilian National Development Bank.
This shift fundamentally alters the DNA of their credit business.
It really does.
Let's break down the mechanics for a second. In their original model, StoneCo was engaged in unsecured lending. They analyzed a merchant's cash flow, advanced them capital, and hoped for the best.
Right.
If the merchant went bankrupt, StoneCo had no collateral to seize. They were just another unsecured creditor writing off a total loss.
Yep.
By integrating with BNDES guarantee programs, StoneCo is essentially originating the loan, but the Brazilian government is providing a backstop.
Exactly.
If the merchant defaults, the government guarantee absorbs a substantial portion of the principal loss.
It's a total de-risking of the balance sheet. But, in finance, risk and return are inextricably linked.
Right, there's no free lunch.
Exactly. The BNDES does not provide these guarantees for free. They mandate strict caps on the interest rates StoneCo is allowed to charge the merchants under these programs.
Ah, so they cap the upside.
Yes.
Yeah.
Consequently, as StoneCo shifts a larger percentage of its $3.2 billion real portfolio into these government-backed facilities, the overall yield of the portfolio will inevitably compress.
So top-line credit revenue would drop, but because the government is eating the default risk, StoneCo's non-cash provisioning expenses will also plummet.
Exactly.
They are basically trading the volatile, high-yield, high-loss model of a fintech cowboy for the lower-margin, highly stable, utility-like returns of a traditional government-subsidized commercial bank.
Which perfectly encapsulates the identity crisis we talked about at the top of the show.
Right.
The payments business is reverting to slow, profitable growth by unwinding complex software bundles. And the credit business is fleeing to the safety of government collateral after its proprietary algorithms failed.
It is a massive de-risking maneuver.
It really is.
And that aggressive repositioning is exactly what is driving the strange, shifting metrics management introduced to guide expectations for the rest of 2026.
Yeah, the shifting of key performance indicators is always a highly scrutinized moment in an earnings call.
Oh, totally. And StoneCo completely reshuffled the deck this quarter.
They did.
They introduced a new unified active client base definition, which counts any client who generated revenue across payments, banking, or credit in the trailing 30 days.
Right.
Under this new umbrella, they reported 4.7 million active clients. But the glaring issue here is that this represents a 5% sequential drop from Q4 2025.
Yeah.
They lost hundreds of thousands of active clients in a single quarter.
And it gets more complicated when you look at how they are monetizing the clients that actually stayed.
Right, the ARPAC metric.
Yeah, they rolled out a brand new metric, ARPAC, or average revenue per active client. They reported an ARPAC of 247 raised per month. But digging into the historical comparables they provided, that ARPAC is down 11% year over year.
Whenever a management team discontinues old growth metrics, introduces a new framework, and the headline numbers of that new framework, total clients and revenue per client, are both actively contracting, my retail investor alarms go off.
As they should.
It looks like they are trying to obscure a secular decline in the core franchise by changing the math. Are they hiding something?
This skepticism is absolutely warranted. Metric rotation is a classic tactic used to buy time during a turnaround.
Right.
But to analyze this objectively, we have to evaluate management's mathematical justification for the contraction.
Okay, let's hear it.
They argue it is driven entirely by the mix effect of their strategic pivot toward digital banking.
The mix effect. Let's dig into that because it's the core of their future growth thesis. Matthews explained that a massive portion of their new client acquisition consists of banking-only clients.
Right.
These are merchants who open a free StoneCo digital checking account, but do not yet use a StoneCo point-of-sale terminal to process payments, nor have they taken out a credit loan.
Right. And from a unit economics perspective, a standalone checking account generates negligible direct revenue, perhaps some minor transaction fees or float income.
Basically nothing.
Exactly. So the specific ARPAC for these banking-only clients is incredibly low. As StoneCo rapidly scales this specific segment, adding hundreds of thousands of these low-revenue accounts into the denominator of their total client pool, it mathematically drags the overall corporate average down by 11%.
Yeah, I see.
Management's argument is that the legacy merchants using payments and credit are still highly profitable in growing their spend, but that growth is masked by the sheer volume of new low-revenue banking clients entering the ecosystem.
Okay, I follow the math, but that begs the question. Why spend capital acquiring and maintaining hundreds of thousands of clients that severely dilute your financial metrics and barely contribute to the bottom line?
Because they view the digital checking account as a zero-cost customer acquisition funnel. It's a long-term land grab. The hardest part of commercial banking is getting a merchant to change their primary operating account. By offering a frictionless free digital account, StoneCo gets their foot in the door.
Right.
More importantly, once the merchant's daily cash flow is moving through the StoneCo ledger, StoneCo gains pristine, real-time visibility into that business's financial health.
Ah, so they are using the banking ledger to feed data back into those credit algorithms we just discussed.
Exactly. The banking account provides the underwriting data. 6 months down the line, StoneCo can push a highly targeted, pre-approved working capital loan or a credit card offer to that merchant.
Sneaky, but smart.
The strategy is to acquire them at a low ARPAC today and systematically cross-sell them into high-margin products to expand their lifetime value tomorrow.
Okay, so that explains the AirPack drop. But how do they justify the 5% drop in total clients? If the strategy is a massive land grab for banking accounts, why is the total unified client base shrinking?
Well, Diego framed the client loss as a conscious action to focus our efforts on a more engaged and revenue-generating client set.
What does that mean?
In the payment processing industry, not all clients are accretive. If you have a micro merchant running a weekend market stall who swipes a card once a month for 50 rays, the cost of maintaining their account, providing customer support, and servicing the physical terminal far exceeds the fractional pennies StoneCo earns on that transaction.
Oh, I see. So they are actively purging the bottom tier of their client base.
They are letting the unprofitable tail churn out without spending marketing dollars to retain them. It artificially shrinks the total client number, but it theoretically improves the overall margin profile of the business.
The logic holds together conceptually, sure, but as an investor, you are being asked to underwrite a significant leap of faith here.
Oh, a massive leap.
We won't know if this mix effect cross-selling strategy is actually working until we see that AR-packed number bottom out and begin to reaccelerate in late 2026 or early 2027. We are entirely dependent on management's ability to execute that cross-sell efficiently.
Which is exactly why their full-year guidance was so heavily scrutinized on this call.
Right.
Despite the Q1 contraction in metrics, management held their full-year 2026 guidance strictly unchanged.
Interesting.
However, Matthias explicitly managed expectations by stating that performance will be significantly weighted towards the second half of the year.
The infamous second half hockey stick projection.
Yep.
It requires everything to go perfectly right in Q3 and Q4. They are modeling that the simplified payment bundles will have stopped the churn, the new credit algorithms will have stabilized the default rates, the BNDES integration will be scaling, and the banking-only clients will start taking loans.
Right. They need all the stars to align.
But even if they execute flawlessly on all those internal operational goals, the Q&A session revealed an external existential threat that could completely derail their entire financial model.
Yes. This is the most critical vulnerability for anyone holding STNE. It completely overshadows the product bundle issues or the algorithmic tweaks. We have to talk about the duration mismatch and the Selic rate.
The Selic rate, that's the Brazilian central bank's benchmark interest rate, right?
Yeah.
Functionally equivalent to the federal funds rate in the U.S.
Seriously.
During the Q&A, analyst Antonio Ruiz from Bank of America pressed management on their interest rate sensitivity. And Diego dropped a staggering piece of context.
He really did.
He admitted that when StoneCo finalized their 2026 financial guidance, their internal models assumed the central bank would cut the sleeve rate down to 12.5% by the end of the year.
Right.
But given the persistent inflationary pressures in the Brazilian macro environment, the market consensus and StoneCo's revised internal expectation is that the Selic will remain elevated, likely anchoring closer to 14%.
Now, a 150 basis point variance might not sound like a crisis in a vacuum, but for StoneCo's specific balance sheet, it is devastating.
How devastating?
Diego quantified the damage. He stated that every 100 basis point increase in the Selic rate directly obliterates 200 to 250 million reais of pre-tax earnings.
Okay, we need to explain the mechanics of this, because why is a payment processor and fintech lender so violently sensitive to a 1% move in the central bank benchmark? Why does StoneCo bleed 250 million reais just because the government holds rates steady?
It comes down to how they fund their primary product offering. StoneCo's most attractive value proposition to a Brazilian merchant is the prepayment feature.
What's that?
In Brazil, when a consumer buys a television on a credit card, the standard settlement cycle dictates that the merchant might not receive the actual cash from the card network for 30 days.
30 days? That's a long time to wait.
Right. The merchant has payroll and inventory costs due tomorrow.
So StoneCo steps into that gap.
Exactly. They offer to advance the cash to the merchant immediately, minus a prepayment discount fee. They are essentially providing a 30-day collateralized bridge loan.
Okay, I follow that.
But StoneCo doesn't just have billions of reais sitting idle in a vault to fund these massive daily cash advances. They have to acquire that capital.
Right, they have to get the money from somewhere.
They borrow it from the wholesale interbank market. And the rate they pay to borrow that capital is dictated by the CDI, the interbank deposit rate, which tracks in lockstep with the Selic rate.
Ah, and here's the trap. StoneCo has already contracted the prepayment discount rate with the merchant. That is a fixed rate asset.
Right.
But the money StoneCo borrows to fund that advance is a variable rate liability tied to the Selic.
That is the duration mismatch. When the central bank decides to hold the Selic at 14% instead of cutting to 12.5%, StoneCo's daily cost of wholesale funding instantly spikes.
Right.
But they cannot instantly renegotiate the prepayment fees across their entire base of 4.7 million merchants without sparking a mass exodus to competitors.
They lose everybody.
Exactly. So the cost of their liabilities explodes, the yield on their assets remains fixed, and the margin in the middle, their pre-tax profit, is simply crushed.
That structural vulnerability means that if inflation accelerates in Brazil and the central bank is forced into a hiking cycle, pushing rates to, say, 15 or 16%, StoneCo's earnings power gets vaporized.
Absolutely vaporized.
And it's completely independent of how well their software performs or how many clients they acquire. They are entirely at the mercy of monetary policy.
Which explains the absolute desperation behind their secondary strategy. They recognize this existential threat, and their only defense mechanism is to aggressively gather retail deposits.
Let's look at the progress there. Retail deposits actually reached 10.1 billion raise, which is an impressive 22% growth year over year.
Yeah, that's a bright spot.
Diego highlighted that this growing deposit base has allowed them to reduce their blended cost of funding from 100% of the CDI rate down to approximately 87% of the CDI. But how does holding merchant checking account balances insulate them from the central bank?
Because retail deposits are the holy grail of banking.
Yeah.
Zero-cost funding.
Explain that.
When StoneCo borrows from the institutional wholesale market, they pay the full, punching 14% CELIC equivalent rate.
Right.
But when a merchant leaves their daily operational cash sitting in the StoneCo digital checking account, StoneCo typically pays 0% interest on those demand deposits.
Oh, wow.
And StoneCo can legally take those 0% retail deposits and use them to fund the cash advances and credit loans for other merchants in their ecosystem.
It effectively breaks their reliance on the wholesale market. Every real they hold in a 0% checking account is a real they don't have to borrow at 14%.
Yeah, precisely. The 22% growth in retail deposits is arguably the most bullish operational metric in the entire earnings report. Driving their blended cost of funding down to 87% of CDI provides a vital buffer against the margin compression.
Okay, but
10.1 billion readers in deposits is still only a fraction of the total volume they need to fund their massive prepayment and credit portfolios. They are still heavily reliant on wholesale funding.
And gathering those deposits is a grueling incremental battle. As Diego pointed out to analyst Ricardo Bushbiga from BTG, StoneCo's core demographic micro and small merchants, they operate on razor-thin margins.
Right, they don't have extra cash just sitting around.
Exactly. They don't have the luxury of leaving massive idle cash balances in a checking account. They deploy their cash immediately to buy inventory or pay rent.
Yep.
So growing that 0% deposit base to a level where it fully hedges the balance sheet against the SELIC rate, that's going to take years, not quarters.
Which means for the entirety of 2026, the company remains largely unhedged against a higher for longer interest rate environment. Diego candidly admitted that it will be a super volatile year and that they are likely to operate near the very bottom of their guidance range explicitly because of the sustained pressure from the CELIC rate.
Which brings us to the ultimate verdict. We have all the data, the story, and the guidance. We've dissected the mechanics of the 15% EPS jump driven by buybacks.
Yep.
We have analyzed the friction and churn in the payments bundles. We have detailed the failure of the underwriting algorithms, the resulting 229% coverage ratio, and the pivot to BNDES secured lending.
Right.
And we've just mapped out the existential duration mismatch driven by the CELIC rate. Synthesizing all of this, what is the actionable perspective for the retail investor listening right now? Are we bullish or bearish?
Based on the structural realities of this transcript, our position is distinctly bifurcated. We are deeply cautious, leaning bearish in the immediate short term, but constructively bullish on a longer term, 18 to 24-month horizon.
Okay, let's validate the short-term bearishness first. Why should an investor expect pain or dead money over the next 2 to 3 quarters?
The short-term mechanics are dominated by two massive headwinds that management cannot quickly resolve. First, you have the immediate quantifiable damage from the CELIC rate staying near 14%.
Right.
That $250 million real pre-tax penalty per 100 basis points is going to actively compress margins in Q2 and Q3. They simply do not have enough retail deposits to offset that cost of funding yet.
Okay, that's one.
Second, you have the lingering contagion from the bad credit underwriting. Even though they deployed new algorithms in March, the highly toxic loans they originated in late 2025 and early 2026 are still sitting on the balance sheet.
Waiting to default.
Exactly.
Yeah.
As those older cohorts continue to default, they will require further provisioning. The non-cash expenses will remain elevated, suppressing net income.
And operationally, the fixes they are applying to stop the payments churn rolling out simplified, transparent pricing, That takes time to gain traction.
It does.
You don't instantly win back a merchant's trust after you've frustrated them with a bloated software bundle. You are essentially asking investors to buy into a turnaround story before there is empirical proof the bleeding has stopped.
Exactly.
There are just too many structural headwinds to anticipate an upside earnings surprise in the near term.
Exactly. The short-term setup is defensive at best. But if you have the capital and the patience to look past 2026, the underlying framework they are building supports a really compelling bull case.
Okay, break down the mechanics of the long-term optimism. What makes you bullish?
The foundation of the bull case is their aggressive capital discipline.
The buybacks.
Yes. A management team that recognizes when organic growth is stalling and aggressively returns $3.6 billion in reals to shareholders, generating a 27% yield, is a management team you can trust not to destroy shareholder value on foolish empire-building acquisitions.
Right. They're being realistic.
And the ongoing $1.4 billion real buyback authorization provides a dense layer of downside protection, heavily mitigating the risk of a catastrophic stock collapse.
And from a fundamental business perspective, what's the bull case there?
The pivot to BNDES secured lending fundamentally upgrades the quality of their earnings. Yes, the top-line yields will compress, but the massive reduction in default risk means provisioning expenses will plummet, leading to highly predictable, stable cash flows.
Okay.
Furthermore, if the simplified pricing structure successfully arrests the churn in the payments division, the business is primed for massive operating leverage.
Operating leverage is the key there. They have already absorbed the heavy fixed costs of building the digital banking infrastructure and restructuring the credit models.
Right.
Once that baseline is established, any incremental revenue generated from cross-selling loans or adding new payment volume drops almost entirely to the bottom line.
Exactly.
If the macro environment stabilizes and the Selic rate eventually begins to tick down in 2027, the combination of lower funding costs and a stabilized, lower-risk credit portfolio will cause their net profit margins to expand aggressively.
You've got it.
So, to translate this into direct, actionable advice for the listener, if you currently hold ST&E in your portfolio, your mandate right now is vigilance.
Extreme vigilance.
Do not let the 15% EPS beats placate you, because you now understand that metric is heavily influenced by the buybacks. You need to scrutinize the Q2 and Q3 earnings reports with a specific focus on the asset quality metrics.
Right.
Do not look at the top line revenue. Look exclusively at the first payment default rates. If those rates start climbing again, it means the new underwriting models deployed in March are failing just like the old ones, and the thesis is broken.
And track the deposits.
Exactly. You also need to track the growth of retail deposits. If that 22% growth rate decelerates, their ability to hedge against the central bank evaporates.
And if you are a retail investor sitting on the sidelines, looking at the depressed valuation multiples and considering initiating a position,
what's the play?
our strongest advice is to exercise restraint.
Wait it out.
Yes. The market is not going to suddenly re-rate this stock overnight. Over the next 6 months, ST&E is going to trade entirely as a proxy for Brazilian macroeconomic data.
Right.
If inflation prints hot and the central bank signals further rate hikes, the algorithmic trading models will punish the stock regardless of StoneCo's internal execution.
So what should they look for?
Wait for the macro dust to settle. Wait for the Q2 or Q3 reports to actually prove that the credit bleeding has stopped and the payments churn has stabilized. You might miss the first 5 or 10% of the recovery rally, but you will be buying a fundamentally de-risked asset.
Which brings us to the ultimate overarching thought I want to leave you with today. We just spent this entire deep dive dissecting provisioning ratios, collateralized government lending facilities, the cost of wholesale funding, and the duration mismatch of interest rates.
Yeah, a lot of heavy banking concepts.
Exactly. We analyzed the mechanics of a company desperately trying to gather retail checking deposits just to fund its lending operations.
Which is the exact definition of a traditional commercial bank.
Right. For years, StoneCo commanded a premium valuation multiple from Wall Street because it was classified as an elite, hyper-growth, asset-light fintech software disruptor. They were the Silicon Valley antidote to the bloated, legacy Brazilian banking oligopoly.
That was the dream.
But based on the strategic pivots and the balance sheet mechanics revealed in this transcript, they have systematically abandoned the software-first model.
They really have.
By building a massive lending portfolio, relying on BNDES guarantees, and gathering retail deposits, have they quietly morphed into the exact, heavily regulated, macro-sensitive, balance sheet-heavy financial institution they originally set out to disrupt?
It is the defining paradox of their evolution. And it forces a painful recalibration for the market.
How so?
If StoneCo is no longer a high-margin software provider, but rather a traditional cyclical lender, then investors must stop pricing their equity like a tech startup. They must be valued against traditional banking multiples, which are historically significantly lower. Management faces an uphill battle to prove that their technology ecosystem still provides a structural advantage over a traditional bank loan officer.
Right.
And based on the algorithmic failure we saw in Q1, the market has every right to demand proof before assigning that tech premium again.
It is a profound transition to witness, and one that requires you to look far beyond the polished investor presentation slides and into the granular plumbing of their financial statements. Thank you for joining us on this deep dive. Keep scrutinizing those balance sheets, keep questioning the metric changes, and keep looking for the mechanical truths hidden inside the earnings transcripts. We'll catch you on the next one.